as we get ready for day one of the FRX Beginners Bootcamp. Now today, ladies and gentlemen, for those of you that are brand new, we're going to be discussing what is Forex. Many of you guys are brand new to this industry. You're brand new to this company, and you're going to have a lot to explore with us over the course of the next couple of videos. But in this very video, we want to make sure that you're educated on the actual market. So let's dive right into this and talk about it. Now, the foreign exchange market, now there's definitely an error here. I have a Telegram message, right? But bear with me, right? The foreign exchange market, what exactly is it? Well, the foreign exchange market is one of the most widely traded markets in the world, right? With a total daily average turnover reported to exceed over $6 trillion a day. The Forex market is not based in a central location or exchange. It's the world's digital currency system, and it's open 24 hours a day from Sunday through Friday. Now, depending on what your time zone is, wherever in the world that you are at right now, if you are on an Eastern Standard Time, right? If you're in my region, the Forex market opens on Sunday, 5 p.m. Eastern Standard Time. And then the Forex market closes on Friday at 5 p.m. Eastern Standard Time. Now, these times do not change. This is the official market opening and the official market closing. Now, whatever part of the world that you are in on, simply look up the conversion in time. When is 5 p.m. Eastern Standard Time in your country? Because that is when the Forex market opens for you. And when is Friday, 5 p.m. Eastern Standard Time in your country? Because that's when the exchange market is closing for you. All right, now moving forward, what exactly is exchanged or traded in the Forex market? In the Forex market, currency pairs are traded. Currency pairs are basically a combination of two currencies from two different countries. For example, in Euro USD, the Euro USD pair, the euro is the currency of the Eurozone and the US dollar is the currency of the USA. Now, besides currency pairs, some brokers also offer indices, cryptocurrencies, precious metals, commodities, stock trading opportunities, and more. So once you pick up the skill set of trading, you'll learn that you can use the skill set to trade a wide variety of markets and a wide variety of time frames. And that is very, very important. Now let's look down here at some of these examples. So what you'll see down here is you'll see a list of major currency pairs. These are the major currency pairs because each of these major global currency pairs, such as the euro, the pound, the yen, the Switzerland, the Canadian, the Australian dollar, and the New Zealand dollar are all quoted and tied together with the US dollar. Now, the US dollar is the world's currency reserve, which means when the US dollar is moving, it has an effect on all of the currencies around the world, which is why each of the major currency pairs are as you see here on the screen. Now, in addition to major currency pairs, which are some of the most popular, some of the most volatile, some of the most widely traded currency pairs in the market today, there are also cross-currency pairs. Cross-currency pairs are when you're exchanging the currency between two different countries that does not involve the US dollar. So as an example, if you're trading the euro, you could trade the euro for the pound, or the euro for the chef, or the euro for the CAD, so on and so forth. If you're trading the Japanese yen, you can trade the chef for the yen, the Australian dollar for the yen. Current examples, more examples, pound, you're trading pound against the Australian, you're trading pound against the chef. More examples, the Canadian, you're trading the Canadian against the chef, so on and so forth. And there is a total combination of 28 major and minor pairs that you can trade in the market. Now, again, this does not include indices, cryptocurrencies, metals, and commodities such as gold, silver, oil, Bitcoin, US 30, Apple stocks, etc. Right now, we're just talking about strictly currency pairs. So there are 28 major and minor currency pairs that you can trade on day in and day out. Now, there are also something known as exotic pairs. Now, exotic pairs are not as widely popular. They're not traded as much as the majors and minors due to extreme fluctuations in prices, high spreads, a lot of volatility, so a lot of traders, they feel very, very unsure. So you'll see seasoned traders who want to take bigger, riskier positions, trade exotic pairs. The exotic pairs are a few here, but there are more. You have the US dollar to the South African rand, the USD ZAR. You'll see the US dollar to the Hong Kong dollar, USD HKD, right? You'll see the euro to the Turkish, okay? Right? So there are a lot of different exotic currency pairs that you can trade here as well. Now, moving forward, we're going to continue to talk. Now, who trades in the financial exchange market? Now that we kind of understand when the market is open and what the market does and the things that are traded inside of the market, who trades in the financial markets? Okay, so a wide range of currency pairs are constantly being exchanged as individuals, companies, and organizations conduct global businesses and attempt to take advantage of rate fluctuations. So here are the four major participants that are actively trading in the market. So the first actively trading and the largest of all the participants are the central banks. Central banks are responsible for managing the nation's currency, money supply, and interest rates. And when action is being taken by central banks, right, it is usually a syllabus to the nation's currency. So technically, when you're reading news events from Forex Factory or Market Watch, right, all these news articles that are pushing the currencies around the world, those are the big banks. They're the ones that are putting out the news releases. They're the whales in the market that are really just pushing the market everywhere, and it's really their game. So the central banks are the king inside of the FX market. Now you also have retail banks. Retail banks trade large volumes of currencies on the interbank market. Banks exchange currencies between each other on behalf of large organizations, which is how organizations is spelled in, I think, Europe. That's why it's mixed up like that. And also on behalf of their accounts. So retail banks can be very, very large banks, not the central banks, not the major Federal Reserve banks, but the retail banks like Chase, TD Bank, different type of banks like that, smaller banks. Okay, these are the retail banks, and they have a lot to do with the money that's getting pushed around. Central banks and retail banks really work together a lot. Now there's also something known as corporations. All right, corporations, let's talk about this. Corporations have dealt with companies overseas and take part in foreign exchange markets to transfer funds for imports, exports, and services. So in an easy way to put this, corporations are corporations such as Coca-Cola, Nike, right? These are major corporations that do businesses overseas, and whenever they're making a lot of money and they have to exchange that money back into their currency, this can also affect the market. And last but not least, the smallest participants, which make up about 5% of the total market, is us, the retail traders. All right. Retail traders account for a much lower volume of Forex transactions compared to banks and organizations. By us using both technical analysis and fundamental analysis, retail traders aim to profit from Forex market fluctuations. And that's what we're going to be getting into as we dive a little deeper into today's bootcamp. So let's double this back. Retail traders, you and I, we are basically playing in the foreign exchange market according to the banks. So the banks are the ones pushing around the market. They're the ones making the news. They're the ones putting out the press releases. They're really telling us when the currency of a country is going up and when the currency of a country is going down. What we do is we use technical analysis and fundamental analysis, things that you're going to be learning throughout this boot camp to accurately read what the banks are doing on the chart. And then we're trading in alignment with the banks. So we're basically piggybacking off of them. And if we're doing this correctly, we're able to generate substantial profits in the market. But that does not come without risk. So always remember that when trading in the foreign exchange market, only risk capital should be traded. Risk capital is money that you can afford to lose without jeopardizing your financial lifestyle and security, because you do stand the ability to lose every single dollar that you are depositing into your broker account to get started in the market. So this is why you want to educate yourself, trade on a demo account to get your confidence up, and then go live when you are actually prepared to execute in a live market setting. All righty. So now how do we profit from the foreign exchange market? This is where things are going to get good. Okay. So foreign exchange trading, also known as FX trading or Forex trading, provides the opportunity to speculate on price fluctuations within the FX market. The goal of the FX trading of trading Forex is to forecast one currency's value is to forecast if one currency's value will strengthen or weaken relative to another currency. A Forex trader will encounter several trading opportunities each day due to daily news releases and taking advantage of technical analysis. So this is where we're going to start diving into the charts so you can start seeing something more visual. Now, there are two ways to generate profits. You can buy, aka long the market. This is when the market is positive and going up. We're able to put in buy positions, which are known as long positions, and generate a gain. Or we can also sell, aka short, when the market is negative and going down. So if the market is negative and going down, we can sell in the market, aka short, and also make some substantial gains as the market is going down. You can capitalize in either direction. A participant in the FX market, which is us, can generate a gain trading in either direction of the market. Example, if the market is positive and going up and you enter a buy, aka long, you will generate a profit based on certain factors, and vice versa if the market is negative, like we just stated. Now, FX participants lose money if trading in the opposite direction of the markets. So what does that mean? Well, let's come on over to the market and let's take a look. When we're looking at the market over here, okay, you're going to see that there is going to be a wide range of instruments that's here on the market. So let's take a look at when the market is positive and buying and when the market is negative and selling. If we take a look at this base low right here, we can see a lot of these green bars. And from here all the way to up here, this is the market buying up. This is the market being positive. This is the market going long. And if a trader wants to be able to generate a profit in the markets, we would have to buy. Okay, let's get this together, trading view. Okay, we would have to buy in the market when the market is going up. All right, now what a perfect time for my trading view to start freezing while I'm doing a boot camp. Okay. So let me come over here, guys. Bear with me just one moment as we are taking place and getting this fixed right over here. Okay. And let's put this buy right down there. Let's delete that Y. There goes the buy. And let's come over here and let's update this to a sell. All righty. Perfect. Now let's come back over here. Now, one more time, when the market is positive and going up, we can buy anywhere in this uptrend and we can generate a profit. Now, when the market is going down, as we see right now, GU is continuously pushing down. When the market is going down or being negative, we can also make a profit selling, opening up sell positions in the market when the market is going down. Our goal is to trade in the direction of the market to be able to generate a profit. The way that we lose money in the market is if we are trading in the opposite direction. As an example, let's say we're in the market and we believe that the market was going to continue to go up. So we decided to put in a buy over here. Let's try this again. We tried to put in a buy over here because we believed that the market was going to go up. And what ended up happening was the market actually started coming down. So we were forecasting, we were betting against the market. That's how we lose money. Okay? So let's repeat this one more time. When the market is going up, we want to buy when the market is going up to make money. And when the market is going down, we want to sell when the market is going down to quote unquote make money. We lose money when the market begins to go in the opposite direction. That's how FX traders lose money. This is why FX traders will do technical analysis and fundamental analysis to accurately read what's happening here on the chart to trade in alignment with the banks and generate our profits. All right. Now let's move forward. Now, how can we see the price fluctuations? The price fluctuation, let's talk about this, right? The price fluctuation is when the market is being positive and going up, or when the market is being negative and coming down. And what we're gonna show you right now is the visual representation of how we're able to see the price going up and down. And we do that by looking at something known as candlesticks. So let's talk about this. A candlestick is a type of price chart used in technical analysis to display the high, low, open, and closing of the price of a security for a specific period of time. Forex candles provide a range of information about currency price movement, helping to inform the trader, which is us. Trading Forex using candlestick charts is a useful skill to have and can be applied to all different type of markets. So before we go back over to the live market and we take a second look at it, let's study the anatomy of a candle. Now, whenever you see a candle is green, typically candles are green. Some people or some traders or educators may color them different. You might see them blue. Blue and green is a very popular color. Other people may put them white or any color of their preference. But we're going to stick to the typical green and red currently. So whenever we see a green candle, that means for that specific amount of time. Now, a candle can be any amount of time. It can be a 1 minute time frame. It can be a 5 minute time frame. It can be a 15-minute time frame, an hourly, a 4 hour, a daily, a weekly, a monthly. So whenever you want to look at the price of the markets, you're going to put on the time frame, and in the time frame, the candle is going to represent that. So if you see a green candle, that means that there was a positive outcome in the market, meaning that the market was going up. So let's talk about the body of the candle. Now you're going to see where it says high, close, open, and low. So if a market is going up, you're going to see that the market opens up. That is the actual body of the candle. That's where the market opened. And you'll see this long shadow come down. This long shadow is known as a wick. So this wick is here because the price actually pulled down and it came as low as the wick, but the price could not hold. So the price ended up going back up and then started moving higher. And as the price started moving higher, the body started getting bigger. And eventually the candle made a high point, which is that next wick, but it couldn't hold the high. So when the price came back down within the time frame, this is where the candle ended up closing. So within this specific period of time, we get to see when the market opens, how low it came, how high it came, and then when it actually closed. That's a positive candle. And the same is as true as for a negative candle. Now remember, do not associate negative with losing. Negative is just the word that we're using when the market is going down, right? We could be positive in our accounts, selling in the market. So red does not mean negative, okay? It's just how we're representing the candle. So in a selling, the open is going to open at the top. See, at the buy, the open was at the bottom. For a sell candle, the open is at the top because it's high and it's coming down. Now it's going to open, and if it starts to go back up, we can see how high the candle went. If it comes back down, we can see how low the candle went with the wick, and then we can see where the candle actually closed. So remember, every candle has 4 points: the high, the low, the open, and the close. Let's make more sense of this by visiting the market. Now, if we come back over here to the market, let's take a look at the GBP USD example. First off, let's talk about the time frame. This time frame is currently set to the 1 hour. Now, when you come over here, again, you can set the time frame from 1 second to 1 hour, all the way to a month. We're going to leave it on the 1 hour because the 1 hour is a very, very popular time frame. So what that means is that every single one of these candles is representing an hour in the market. So 1 hour, 2 hours, 3 hours, 4 hours, 5, 6, 7, 8. So it has roughly been about 8 hours since the market has been selling off. Now let's take a look at the candle one more time. Okay, bullish and bearish candles are positive and negative candles. So let's take a look at this. Okay, let's draw our line and let's take a look here. This is where the candle ended up opening, right there, because it's a negative candle, it's a bearish candle. That's where the candle ended up opening. It has no wick, meaning that the market never went up. Now the market pushed down, and what we can see, let's zoom in a little bit more. We can see there's a little tiny wick. That means that that's how low the market came, but it didn't stay that low. It pushed back up, and then this is where the market ended up closing, right over here. Now, once this candle closed, the next candle ends up opening. Where does the next candle open? The next candle opens right where the previous candle closed. And now we can see a little wick, meaning that's how high the market started going up, and the market came down, made a wick. That's how low the market went. It could not hold, right over here. And then the market went back up and closed right there. And this is how it works. It opened, it closes. Where it closes, the next one opens, it comes down, it closes. When it closes, the next one opens, comes down, it closes. Now, when the candles start to change, you'll see the same as is true. Let's look at these bullish candles or these buy candles over here. When this candle finally closed, the next one opened. But this one, instead of continuing to go down and make a red candle, this started going up above the close. And that's why the candle is now green, because it's going higher than when the candle closed. And the next one, it closed, the next one opened, it continued to go higher and made another green candle. It closed, next one opened, continued to go higher and made the green candle. And it went very high. You can see the wick over here. It went very high, but it could not hold that high. And it came right back down here where the candle closed and the next one opened. Now, one more time. When this one opened, it's turned red because it's not going up anymore. It's now going down. So now we see the candle red because it's going down. This candle closed, the next one opened, and it continued going down. And in this market that you see right here currently, this market you see right here currently is currently an open candle. So this is the price of GBP USD in real time on a 1 hour candlestick. This is how low it came, and this is where the current candle is at. So take a look. You'll see as the price fluctuates at this particular time, you're going to see the body of the candle going up and down. Right now, you see the candle going up, and now you see it coming down just a little bit. Okay. Now, once this hour is done and this candle closes, the next candle is going to open right after that. This is how we read candles inside of the market. And it's very, very simple. So you see green candles, the market is bullish, it's coming up. You see red candles, the market is bearish, and it is coming down. Where one candle closes, the next candle opens. Now, coming back over here, talking about price fluctuations, let's talk a little bit more about how to actually read price fluctuations. Now, buying and selling in the Forex market is speculating on the upwards and downwards price movement of a currency pair with the hopes of making a profit. So all Forex trading involves buying one currency pair and selling another. That's what we're doing, which is why it's quoted in pairs. So you would buy the pair if you expect the base currency to strengthen against the quote currency. If you would sell, you would expect it to do the opposite. So taking a look at this example right over here, let's say GU, that's what we're looking at. We're looking at GU. GU is the base currency. So the first pair that it's opened is the base currency. The second pair is the quoted pair against the base currency. And that's going to equal a price on the charts. Okay? So let's take a look. Forex markets are always quoted in pairs. GBP, USD, Euro, USD, Chef, USD, CAD, JPY. They're always quoted in pairs because you're buying one, you're selling the other. The price of the pair is how much of the quote currency costs to buy one unit of the base currency. And when you're trading, you are always buying one and selling the other. A little redundant just reading the steps on the screen. So basically, you'll see GBP USD is at 1.3200 or 1.32 thousand. This is the actual price. What does this mean? This means that 1 pound, okay, it means that 1 pound is worth or cost $1.32 for the Euro USD. Does that make sense? So 1 pound is the same exact price of $1.32. Okay? So you would need $1.32 to equal 1 pound. You would need $1.32 to equal 1 pound. That's the currency exchange. Let me come over here and show you what we mean. All righty? Now, taking a look at these candles, let's back up some of this stuff over here. Taking a look at some of these candles, you'll see right here on the right-hand side, you will see the price of the asset. Again, we're on GBP USD on the 1 hour. And you'll see this red highlight. It says 1.38, 127, 121. You see how it's changing? Let's write this up on the screen. The current price is 1.38. Right now is at 142. 142. Let's make this a little bit bigger. 28. Let's make this even bigger. Let's put this on 40. Okay? This is the current price of the pound to the US dollar. So right now, on this specific day, it is $1.38 in US dollars to equal 1 pound. Now you see how the market is continuously going up and continuously going down, and there is a change in price. That change in price is the fluctuation. That's the fluctuation going up and down. that we're able to capitalize on and make money on. That's what the banks, the hedge funds, the corporations, this is what we are doing. We are trading the fluctuation in these prices to generate a profit. So let's go back and we're going to dive a little bit deeper. Okay. So let's talk about how to calculate a pip inside the market. Now, what is a pip? A pip is short for percentage in point. It is the unit of measurement to express the change of value between two currency pairs. Okay, it's a pip. That's called a pip. So if we're looking over here, if Euro USD moves from 1.1005 to 1.1006, that 0.0001 decimal that the USD exchange is the rise of value in one pip. Okay? A pip is usually the fourth decimal in place of the price quotes, with the exception of the Japanese yens. So let's come back over to the chart and let's talk about the price and the pips. So what we're going to do is let's look at this previous candle right over here. We're going to look at this candle and we can see that this candle opened up at 1.38609. So let's come over here, 1.38609. That was the opening price of this candle. Okay? Now, within an hour's time, we had a negative candle. The market was bearish and coming down. And the market ended up closing in 1 hour at this price. And this price here is, let's come and read it. This price here is 1.38. My trading view is still frozen, 1.38378. Okay, give me just one moment. There we go. 1.38378. So what I want you to look at is I want you to look at the difference in the price here. So when we're looking at this price, let's not open this up. When we're looking at this price, let's look at the base. This right here, which is the first two, right? These decimal points right here. Let's see if we can open this a little bit more to fit in there. There we go. Okay. 1.38, that is the hard price. $1.38 to 1 US pound. Now you're going to see the third and the fourth decimal, not the 9. Let's cut out the 9. That is the pipette. It still counts, but we're going to cut that out for now. Let's just look at the 60. The 60 is what we are reading. And every time this changes, this is when the market is moving a pip in the market. So as an example, if the price goes from 1.38609, or let's get rid of the 9, to 1.3859, because this market is moving down, that is 1 pip. And then it's going to go down to 1.3858. And it's going to go down again to 1.3857. So on and so forth until it reaches whatever price it's going to go. So every single time the third and fourth decimal is changing, that is the market moving a pip. And this is extremely, extremely important because you're going to hear many traders say, I'm catching pips. How many pips did you catch? How many pips did the market move? Or they might say points or pips. And this is where the money is being made. Every time the market moves a point or a pip, that is the actual exchange or the fluctuation in currency. This is the whole thing that you need to understand right here. Every time the market moves 1 pip, That is the fluctuation in price. Every time that market moves 1 pip, you get to generate a profit or lose a profit if you're trading in the opposite direction of the market. Okay, so let's look at this example from here. What I'm going to do is I'm going to use this little ruler, and this ruler is going to tell me the difference in pips. So from here to here, that was a 24.3, or let's just keep an even number. That was about a 24 pip difference on average. That's about a 24 pip difference in 1 hour that the market moved, which can be incredible to catch 24 pips inside of the market. All righty. Now let's come back over here. Now there is an exception to the USD JPY. Now, anytime that you are reading any pairs that are quoted to the Japanese yen, this is typically the second decimal. It's not as long where it has 4 decimals, like the traditional pairs. Only the yen, you will use the second decimal. So this goes from 20 to 21, that moves a pip. It goes from 21 to 22, that's another pip. From 22 to 23, that's another pip. So remember, the yen is the second decimal. Any other currency pair is typically the 4th decimal out. All righty? Now, let's come back over here. Now, what is traded inside of the market to be able to actually make money, right? This is called a lot size, AKA a position, okay? This is called a lot size, AKA a position. So a lot size is a measure to efficiently communicate quantities of currency transactions. And it's far easier to say 1 lot size than saying 100,000 US dollars. So for an example, 1 standard lot size of EU is equal to 100,000 units of, or 100,000 pennies, I guess you can say, of the euro, if that's politically correct. So this can be extremely complicated to explain. And quite honestly, with me trading about 7 years inside of the market, it's still hard for me to explain it. But what I do know is how to read it and how to make money with it. And that's what you want to know. So let's not worry about all of the intricate stuff. Let's get down to the real nitty-gritty and focus on what is important. And what is important is the positions that you are trading in the market to generate a profit. Now, there are 3 major positions that you can trade, but you're not limited to these positions. So you have a micro, you have a mini, and you have a standard, okay? You have a micro, a mini, and a standard. Now, for some reason, I believe that this is incorrect over here. This is saying a mini. This is a micro. Okay, these examples are a little bit incorrect. So let's not look at those. Let's just stick over here. So a micro, a mini, and a standard. This is basically what you are leveraging and what you are risking in the market to be able to make money. So every single time that the market moves a pip, you're going to generate a profit depending on your lot size. So let's come over here and let's take a look at this. How can we calculate profits using pips and lots? Well, I like to call this the pip formula. And then we're going to go back to the market and we're going to talk about this and we're going to recap this and make it a lot more simpler. Okay? So let's talk about the pip formula, right? The pip formula is your lot size times 10. Why is it your lot size times 10? Well, an easy way to understand this is that whatever lot size you are trading, whether it is, let's go back, whether it's a 0.01, a 0.10, or a standard, it could be a 0.27, it could be a 0.49, it could be whatever it is that you're willing to trade. Whatever it is that you're trading, let's go back to the micro, whatever it is that you are trading, you have to times that number by 10. And that is how much you are standing to gain or lose per point, per pip the market is moving. So for me, I created the pip formula. So it's very simple. So let's say in this example, we are trading a 0.10. A 0.10 looks like a 10 cents position. But if you're going to become a trader and an investor, understand that that is a politically incorrect term. It's not a 10-cent position. You're just leveraging a 0.10 inside of the market. It's not a 10 cents position. You're leveraging a 0.10. So if you're leveraging a 0.10, which looks like quote unquote 10 cents, you have to times that number by 10 to see how much money that you are making per pip. So as an example, if I have 10 cents, if I have a dime, if I have 10 cents and I times 10 by 10 in terms of US dollars, what does that make? That makes $1, right? So 10 cents, so if you have 10 dimes, does that make $1? Yes, it does, right? So there you go. So you take your lot size, you times it by 10. That's how you know how much money you're making per pip. And now you multiply that by the number of pips the market has moved. So in this example, if I was trading a 0.10, which is generating me $1 per pip, and the market moved 10 pips, well, I have successfully gained a $10 profit in the market. And let's move on to another example. If I had decided to trade a standard lot size, which looks like $1, which is politically incorrect, it looks like $1 US. If I trade a standard lot size, which is 1.00, and if I times that by 10, I am now making $10 per pip, okay? So if I'm making $10 per pip and the market moved 10 pips, that means I am making $100 in the market. This is the pip formula. Now let's come back over to the market and let's look at what we're talking about over here. So one more time, let's take a look at this current price of GBP USD. So we remember that in this particular candle right over here, this market moved 24 points. So if I was trading, let's say I wanted to trade, I don't know, a 0.50, okay? Let's say I wanted to trade a 0.50, okay? So my trading position is going to equal 0.50 on my MT4. Now that trading position equals, let's talk about dollar amounts, 0.50 times 10 is what? That is $5 US per point the market is moving. All righty? Now, if I want to know how much money that I'm making from here, what I then have to do is say, okay, if I'm making $5 US per point, and I'm going to times that by the market moved 24 pips, well, what is $5 times 24? That's 124 US. So I could have potentially gained $124 US profit in this 1 hour candle if I was trading a 0.50. Okay, let's try a bigger example over here. Let's say in this example, we decided to buy at this market low, and this market went all the way up here. This was about 155 points that the market moved in about 3 days. A very, very substantial move. Now, a move like this can happen in 3 days. A move like this can happen in an hour. Okay? So this is a 155 point move. So let's try this again. Let's say I was trading a standard lot. Let's say I was trading a standard lot, which is a 1.00. And on that standard lot, I'm generating 10 USD per point Because remember, every lot generates $10 per point. Okay? And if the market moved 155 points, then what am I doing? I am basically taking $10 and I'm timesing that by 155, which means that I am going to end up making $1,550 over the course of these 3 days. And this does not include putting in multiple positions. Now, later down the line, you guys are going to learn that when you successfully forecast a market direction, you don't just have to put in one buy. As the market's going up, you can learn how to put in a second position. You can put in a third position. You can put in a fourth position. You can put in position after position after position, and you can successfully turn one move in the market into multiple different positions, creating multiple opportunities to profit inside of the markets. You're going to be learning that down the line. Okay? Now, let's come back over here. All right? So that is the PIP formula. So whatever your lot size that you're trading, you're going to times that by 10 times the number of pips. Now, luckily, when you're trading on your MT4, this math is automatically done for you. You don't have to actually sit here and count it and do all this. It's just important for you to know. This is the things that you want to have stored in the back of your mind. Now, moving forward, let's talk about a spread, because the brokers have to make money. Let's not forget that in order for you to be able to access the foreign exchange market, you're going to need a middleman, and that middleman is going to be the broker. So it does not matter if you're the richest person on planet Earth or if you are Joe Schmo. Every single person on planet Earth needs to open up a broker account, and the broker account is going to allow us to participate in the Forex markets. Now, the broker being the middleman that lets us participate in the financial market, how do they make money? Well, there are multiple types of brokers. You have dealing desk brokers and you have profit sharing brokers. You want to go with a profit sharing broker. A profit sharing broker is basically a broker that makes money off the spreads and when you win in the market. So they actually want you to win. A dealing desk broker wants you to lose. They are in bed with the big banks. They're the ones that want to manipulate the prices the most. They want to have the highest spreads. They want to jack things up. So that way you are losing. So they make more money when you are losing. Okay? That's a dealing desk broker. A profit sharing broker makes money when you make money. And you want to be with a profit sharing broker. Okay? Now let's talk about the spread, because the spread is how the broker makes money. So the Forex spread is the difference between the Forex broker's sell and buy rate when exchanging or trading currencies. Spreads can be narrow or wider depending on the currency involved, the time of day, the time the trade is initiated, and the economic conditions. Okay? So long story short, you want to be able to get into the market when the spread is low. So let's look at this. Let's say we're looking at the base currency, GBP USD, and the bid price or the actual price right now is 1.3089. Now the ask price for the broker is 1.3091. Oh, I'm so sorry. This is backwards. The ask price is what you want. The bid price is where you get in. Okay? And what you do is when you look over here at the 89 to 91, what is the difference in price? Well, you have 89, 90, 91, right? That is a 2 pip difference. That means that you need to make 2 pips of profit before you can start generating profit, because the broker has to get the spread first. This is why every single Forex trade that you open is going to automatically start negative. How negative you start depends on the spread. Now, if you're trading on your MetaTrader 4 on your phone, your prices are going to look a lot like this. When you're opening up your quote list and you're looking at all your prices, you're going to see this. It's going to say 1.3085, 1.3087. Okay? That difference that you see between all the pairs is the spread. And typically, the broker will actually give you the spread amount. It will usually list it out, as far as I'm aware. And right under the pair on your MT4, it'll say spread is 12, spread is 7, spread is 14, spread is 9, spread is 6, spread is 67, whatever the case is, okay? That spread is telling you how many pips. So if it's 0.9, it's about a pip. If you have something that's about 67, you're talking about a 6 pip difference in the market. And that is a big spread. So you don't normally want to go into a pair especially if the spread is over 10 pips. Like if the spread is over 10 pips, I am not getting in it. I don't even like a 5 pip spread. I like 2 pip, 3 pip. I'll deal with a 4 pip spread, but I don't like very high spreads. So if you have a very high spread, understand that you're going to start in the negative on the trade. And then if the trade goes against you, you're going to feel like you're in the double red. And that's where Forex trading is just not fun. Okay, so let's come over here. Let's come back to the market, and then let's speculate on what a spread price would look like. Okay, so let's do this. Let's just come over here. Okay, no, you know what? Let's just do this. Let me get rid of this so that way nobody's confused. Okay, and get rid of all of this here. Okay, so let's revisit spread. So let's say we're trading in the GBP USD marketplace. And let's say right now, this is the market right now in real time. This market right now in real time is at 1.38033. 1.38033. Okay. Let's try this again. 1.3803. Okay, guys, just give me just one moment here, right? Those moments when your laptop is freezing for absolutely no reason? That's what's happening right here, right now. Okay, so let's try this one more time. 1.38033. Come on, be on your best behavior. 1.3833. So let's say this is the real price right now of GBP USD. Now what the broker is going to do says, okay, if you want to be able to get into this market here, okay, I'm going to put you in, okay, I'm going to put you in here. Okay. I'm going to put, well, it's actually after. I'm going to put you in here. So let's put this back up. This is where you want to get in, 1.38033. And the broker says, okay, if you want to get in at 1.3833, I'm going to put you in at, let's say we'll do a 2 pip difference. The broker says, okay, I'm going to put you in at 1.3805. That's when I'm going to put you in. That's when the broker is going to put you in to the trade. So let's just get this okay, rock and rolling. And then this is where you have to pass 1.38035 to actually go into profit on your trade. So that small gap right there is known as the spread. And you have to make up the spread. If it's 2 pips, 3 pips, 4 pips, 5 pips, or whatever it is, you have to make up that spread first so the brokers can make their money. And then everything after that is all fair game. Okay? Now, again, always get in a low spread. But mainly, you shouldn't have much of an issue because if you're going in trades that are going 20, 30, 40, 50 pips, in your direction, that's a very, very small price to pay compared to the total reward that you can generate. All righty, ladies and gentlemen, so that is your spread. Now let's move forward, and this is where we're going to end it off before we give a quick recap of today's lesson. And we're going to leave you off today with what are pending orders, okay? So a pending order in the Forex market, or, the foreign exchange market, all right, instructs your broker to automatically buy or sell a currency when the market has reached a certain price in the future. There's actually 5 different execution types, all righty? The first execution type is known as instant execution, which you do not see here on your screen. So if we come back over here, let's take a look at another pair. Let's go to EU. All right. An instant execution would mean that right now, this very, very moment, okay, means that if you put in a sell, you're going to jump in the market right now at the current price, and you're expecting the market to come down. If you put in a buy, that means right now at this specific point in time, you are expecting the broker to start coming up. And you get in right then, right there, right now, however it is that you want to call it. That is an instant execution. Anytime you're opening up your MT4 to take a trade, it will typically be on instant execution. And you could just slap that buy or sell button. Now, when you are trading within IM Mastery Academy, and you're trading with the different educators, and you're trading with the different strategies here, the educators, including myself and many of the different educators that you will eventually be trading with, may give you specific zones where you can choose to trade. And they'll give you certain buy stop orders, sell stop orders, buy limit orders, sell limit orders. Okay, or even when you're doing this on your own. So when you're trading, it's important to understand that there are different ways to execute orders. So let's go to some of the easiest orders, which is the buy stop and the sell stop order. Okay, so this basically means that you have a trigger price. And I like to look at the buy stop and the sell stop like a bus stop. What does a bus do? A bus comes right to your bus stop, your trigger price, and then it just keeps going, right? And you have to be there to get on that bus for the bus to keep going, okay? So a buy stop and a sell stop is where the market reaches a price and it automatically enters you in the trade if you are not present because you set that order. So let's come over here. Let's look at a buy stop and sell stop. So as an example for a buy stop and sell stop, let's say you are looking at the market right over here. Okay, let's say you're looking at the market right over here, or you're looking at the market at a high right up here. All right, let's look at these two areas inside of the market. Okay, we're going to get rid of this. Let's get rid of this. Let's get rid of this. All right. So now, if you're looking for a sell stop is when the markets, we're going to come down here. Let's get our handy dandy text up. Let's say a sell stop. Okay. And then let's say that sell stop price is 1.18209. Okay, and we're going to move this over. We're only going a little slow just to keep up with the with the lag in the computer. And then let's say this buy stop right here is 1.18906. 1.18906. All righty, and this is a buy stop. All righty, there we go. Buy stop and sell stop. So if we're looking at, let's say, a sell stop, this means that at any point in time, as long as price did not reach this area on your MT4, you can put a sell stop of, let's say, what price is this? Yeah, 1.18209. That means that when the markets, all right, family, I want you guys to follow me. Okay. That means that when the market begins to come down and when the market reaches and crosses this price point right here of 1.18209, it will automatically enter you in the trade. That's it. Like right now, you see how the red candle is breaking below the black line, the sell stop line. That's it. You're automatically in the trade. And as long as that red candle continues to drop lower, you would be in profit for the trade. Okay? And if the market, going back to good old buying and selling, if the market comes above the buy stop, that is the drawdown. That is the money that you are at risk of, and your account will be negative. Okay, remember, you need to trade in the direction of the market to make money. And if it comes in the opposite direction, that's how you are losing money. So the sell stop will automatically execute you in a sell when price passes that point. And the same thing for the buy stop. If you are speculating on the price to increase past this particular price level and go higher, let's say to this green line, you would put in a buy stop at 1.18906. And if the price reaches and breaks above that 18906, will automatically trigger you for the buy, and you'll be in profit as long as the market continues to come up. All right. So that is a buy stop and a sell stop. Now, the second two type of orders are buy limits and sell limits. This is where you're expecting the price to stop and reverse at that particular level. Okay, stop and reverse at that particular level. So let's actually change this from buy stop to sell limit. And let's change this sell stop to a buy limit. Okay. So we'll keep the same exact price points. So a buy limit is where you are expecting the price, when it comes down to this black line, if you don't believe that the market's going to keep coming down and you believe that the market is going to stop right around that black line and start to be positive and go up inside of the market like this here, so then that's when you put in a buy limit. So again, let's say an educator may be giving you a buy stop or a sell stop, or maybe you are looking for a point to buy and sell in the future, and you might be busy with work, right? You might be busy with the kids. You might be busy doing anything else, and you know that you're not going to be there when the price hits that area, but you don't want to miss out on that trade idea. Well, then you put in a buy stop. The buy stop and the sell and the buy limit and the sell limit is like a game of handball. You know when the handball hits the wall and then bounces off? That's exactly what a buy limit and a sell limit is. So a buy limit is where you're expecting it to hit that buy, hit that zone, and go up and put you in profit. And a sell limit is the same thing, but opposite. You're expecting it to hit that top, right? And then turn around and start going down. That is a sell limit. All right. And it's pretty much as simple as that. Those are the order and the execution types that you want to be aware of when getting involved in the trading arena. So be sure that you guys are keeping this information. If you are new to trading within the financial markets, if you're new to I Am Mastery Academy, be sure to rewatch this video, as this video was condensed with a massive amount of information. All righty. Now, before we get ready to wrap this up and close out today's Beginners Bootcamp, we're going to recap what we basically went over today, so that way nobody is lost. All righty. So let's recap and let's come over here to a nice, clean, easy peasy chart. All right. We're going to go all the way back to the beginning. So again, what is Forex, right? Forex is the largest financial trading market in the world that is trading over $6 trillion per day. It's all of the money in the world getting exchanged online in real time, 24 hours a day, 5.5 days out of the week, which is great, meaning that you can stand to generate a profit at any time of the day, any day that the market is open, which is great. All right. In the financial exchange market, you can trade dozens of different currencies, major currencies, minor currencies, exotic currencies. You can dabble into other realms by trading indices, which are like stocks, US 30, Apple. You can trade cryptocurrencies like Bitcoin and different things like that. You can trade metals like gold, silver, commodities like oil, right? You can trade all of these different things, all these different markets with one skill set, because they all do the same thing, which is buying and selling. And in the market, you have major players. The biggest players are the banks. The smallest players are the retail traders. And we are basically just reading the market to make sure that we're trading in the direction that the banks are moving the market. So that way we can piggyback off of them and generate some profits. In the market, we're either buying or we're selling. That's it. If we're buying and the market is going up, we're making money. If we're selling and the market is going down, we are making money. If it's doing the opposite, that's how we lose money. All right. The candles are how we actually read the price. Watching the candles go up means the market is going up. Seeing the candles come down means the market is coming down. That's how we know the direction of the market. All righty. We're making money off the fluctuation of the prices. So as any currency pairs are exchanging in the prices and it's moving those pip counts, okay, that's where we're actually making money. All right. So one more time, if the market is red and coming down and we're selling, we're making money. And when we look at the exchange, if the exchange, every time that exchange goes down 1 point, we're making profit. All righty. It's an absolutely amazing game to play. The money that we make is going to be determined based on the lot sizes that we are trading, micro, mini, standard, whatever it is that you want to risk in the market. And never forget your PIP formula, because your PIP formula will help you speculate how much money you're going to make on a specific move. Do you want to trade a 0.10, which is making you $1, and you're going to take the market for 10 points? Are you going to make $10? Is the market going to go 100 points? Are you going to make $100? So on and so forth. Always keep in mind that when you're trading, there are going to be spreads, and the spread is the money that the broker needs to make before you can make your money. That's the price, the toll that you have to pay to play in the foreign exchange market. So make sure your spread is always low, so that way you have a bigger chance to capitalize in the market. And don't forget, there are several different type of entry orders you can put. Market execution being the buy now, sell now button. And then you also have the buy stop and the sell stop, which is the bus stop. It's the stop and go, or the buy limit and the sell limit, which is the handball. I want it to stop and reverse. Okay, ladies and gentlemen. So with that being said, we're going to get ready to conclude the FRX Harmonics Beginners Bootcamp Day 1.